We are currently witnessing one of the most deceptive liquidity environments in the history of the digital asset market. While the retail crowd is celebrating headlines and political promises, on-chain data reveals a massive, silent transfer of wealth from weak hands to sovereign entities. If you are holding Bitcoin or Ethereum right now, you need to understand that the market structure has fundamentally changed beneath your feet. You are likely waiting for a signal that has already been fired. And by the time the broader public reacts, the opportunity for asymmetric upside will have vanished. Over the next few minutes, I am going to deconstruct the last 12 months of political maneuvering and correlate it directly with wallet behavior that the mainstream media is ignoring. I will show you exactly how the promise to make the United States the crypto capital of the planet has altered the global supply dynamics of Bitcoin. Let us get into the weeds. It has been exactly 1 year since Donald Trump stood before the industry and promised to transform the United States into the undeniable crypto capital of the planet. The rhetoric at the time was incredibly strong, promising a strategic national Bitcoin stockpile and an end to the antagonistic regulatory environment. However, as a market strategist, I do not care about speeches or campaign promises. I care about capital flows, legislative execution, and the verifiable movement of coins on the ledger. The reality is that the market has spent the last year pricing in a scenario that most retail investors have completely misunderstood. When we look at the 30-day moving average of exchange inflows, we see a pattern that we have not seen since late 2020. Typically, when a pro-industry administration takes power, we expect to see a flood of speculative retail capital entering the market. However, the data shows that retail volume has actually remained stagnant relative to the price appreciation we have witnessed. This anomaly tells us that the buying pressure is not coming from the individual investor anticipating a new golden age. Instead, the buying pressure is coming from custodial institutions and private equity firms that are front-running the actual implementation of policy. Here is why this matters to your portfolio. The promise of a strategic Bitcoin reserve created a floor price for the asset, but not in the way you might think. The United States government did not need to go onto the open market and buy 1 million Bitcoin to move the price. The mere credible threat that the United States government might hoard Bitcoin forced every other sovereign nation and major financial institution to acquire a hedge immediately. We call this game theory activation. In the last 12 months, we have seen the supply of Bitcoin on exchanges drop to a 5-year low. Yet the United States Treasury has not officially disclosed a massive open market purchase. This means the Trump trade was not about the government buying. It was about the government signaling that they would stop selling. By halting the auctions of seized assets, the administration effectively removed billions of dollars of sell pressure from the order books. This brings us to the regulatory landscape, which is where the real structural damage was repaired. For years, the Securities and Exchange Commission operated with a regulation by enforcement approach that stifled innovation and drove capital offshore. Over the last year, the replacement of key leadership figures at the Securities and Exchange Commission has resulted in a dramatic decline in Wells notices issued to crypto companies. This regulatory thaw has allowed major United States banks to finally enter the custody game. We are seeing traditional financial giants now holding digital assets on their balance sheets, something that was effectively illegal under the previous accounting bulletins. If this level of deep dive analysis is helping you see the market clearly, consider subscribing to ensure you remain ahead of the herd. Now, we need to talk about the energy sector and Bitcoin mining, because this is where the crypto capital promise faces its harshest reality check. The promise was that all future Bitcoin would be minted in the United States. While that sounds patriotic and bullish, the logistics of energy infrastructure make this incredibly difficult to achieve in a single year. Our data shows that the United States has indeed increased its share of the global hash rate, but not to the level of total dominance that was promised. The global hash rate has risen by nearly 40% in the last 12 months, but a significant portion of that growth is still coming from the Middle East and parts of Latin America. Why is this happening? Because while the federal government has become friendly to Bitcoin, State-level energy policies are still highly fragmented. We are seeing a migration of miners within the United States, moving from states with high regulatory friction to states that have embraced the new federal mandate. This internal migration has caused temporary volatility in the difficulty adjustment, which savvy traders have been able to exploit. However, the most critical aspect of this new era is the integration of stablecoins into the global banking system. The administration realized that stablecoins are not a threat to the United States dollar, but rather the greatest source of demand for United States Treasury bonds. By allowing stablecoin issuers to operate with clarity, the United States has effectively digitized the dollar and exported it to emerging markets at a record pace. The market capitalization of dollar-pegged stablecoins has exploded over the last year, reaching levels that rival the money supply of major nations. This is the hidden legacy of the crypto capital promise. It is not just about Bitcoin going up in price. It is about the United States dollar entrenching itself as the settlement layer for the digital economy. If you are betting against this trend, you are betting against the geopolitical interests of the United States, which is historically a losing trade. Let us pivot to the institutional landscape, specifically regarding the exchange-traded funds. The inflows into the spot Bitcoin exchange-traded funds have been relentless, but the character of these inflows has shifted. In the first year of their existence, the flows were driven by pent-up demand and rotation from closed-end funds. In this second phase under the new political regime, we are seeing flows driven by model portfolios and sovereign wealth funds. These are allocators who do not sell when the price drops 10%. They are allocators who rebalance quarterly and hold for a decade. This creates a supply shock that is far more severe than the halving event itself. When you combine a reduction in available supply with a political mandate to protect the industry, you create a powder keg for valuation. However, I must warn you about the risks that still remain in this environment. The market is currently pricing in perfection. Investors are assuming that every promise made regarding the strategic reserve and tax incentives will be implemented without friction. The reality is that the legislative branch moves much slower than the executive branch. We are seeing gridlock on specific tax bills that were supposed to exempt small crypto transactions from capital gains taxes. If these bills fail to pass, we could see a short-term capitulation event as retail investors realize that the tax holiday is not coming. Furthermore, we must look at the global reaction to the United States pivoting to a pro-crypto stance. We have observed significant accumulation from wallets associated with the BRICS nations. It appears that the United States embracing Bitcoin has accelerated the desire for other nations to decouple from the dollar, ironically using the very asset the United States is trying to co-opt. This geopolitical tug-of-war is good for the price of Bitcoin, but it introduces volatility that most retail investors are not prepared for. If you appreciate an objective look at these geopolitical factors, please hit the like button to help this intelligence reach more serious investors. So, where does this leave us 1 year later? The United States is undeniably a more hospitable environment for digital assets than it was 12 months ago. The existential threat of a total ban has been reduced to near zero. However, the crypto capital label is still a work in progress rather than a completed mission. The banking rails are opening up, but they are not fully fluid yet. The mining industry is growing, but it is constrained by grid capacity. The strategic reserve is currently more of a policy stance than a physical vault filled with 1 million coins. But here is the most important takeaway for your strategy. The smart money is not waiting for the final ribbon-cutting ceremony. They are accumulating now because the trend is irreversible. The government has signaled that it views Bitcoin as a strategic asset rather than a criminal tool. Once that psychological shift happens at the federal level, it trickles down to every endowment, pension fund, and family office in the country. We are in the early stages of a sovereign adoption cycle. The price action you are seeing today is just the tremors before the earthquake. Your job is to separate the signal from the noise. Do not get distracted by the daily price fluctuations or the sensationalist headlines. Focus on the liquidity. Focus on the fact that the supply on exchanges is draining while the political cover for owning this asset is increasing. The playbook for the next year is simple, but requires discipline. You must ignore the leverage and focus on spot accumulation. The market makers will try to flush out the late leveraged longs who are chasing the Trump pump. Do not give them your coins. The reality is that we are witnessing the merger of state and money in the digital age. The United States has made its move, and the rest of the world is forced to respond. This is no longer a speculative tech trade. It is a global macro play. Stay positioned accordingly. Please remember that I am a market strategist and commentator, not your personal financial advisor. All investment strategies and investments involve risk of loss. Nothing contained in this video should be construed as investment advice. Any reference to an investment's past or potential performance is not and should not be construed as a recommendation or as a guarantee of any specific outcome or profit. You must conduct your own due diligence and consult with a certified financial professional before making any investment decisions. The market does not care about your feelings, so ensure your strategy is built on data, not hope.